Start over again, please, David. We want to get that insight.
Yeah, so this report is actually very close to what we're looking for here. As we're tracing out inflation, we can see it coming right down to below 2% on the consumption deflator by the fourth quarter of next year. And I think what's really important about this report is there's a large camp of people who say that the last mile is sticky, getting from 3 to 2 is sticky. And we don't see that at all. We're going to step down inflation all the way through the fourth quarter of next year. And what I think this report is showing is across the board, there's disinflation in the U.S. economy, and we're heading back to 2%. And I think that is gradually changing the minds of the markets. And I think that's why you're seeing this move here.
Although it's not necessarily coming with pain, David. And this goes to the soft landing nirvana that Neil Dutta was talking about, that real average hourly earnings increased by 0.8%, up from 0.5%. People's earnings are exceeding the pace of inflation in a material way for the first time in a long time. How much does that lead to a stickiness because people have the means to keep paying the prices?
I don't think so, because we've had periods of positive real wage growth before. But what I'm seeing looking at the earnings reports from the last quarter is companies are very focused on holding earnings in check. Now, yes, you can say that today's earnings are higher than inflation, but from a worker's perspective, they're not even getting catch up from all the inflation they saw over the last 2 years. So what you're seeing is partial compensation for previous inflation, but I don't see a lot of evidence that companies are being able to push higher prices, the workers are being able to push higher wages. So overall, I think what we're not seeing a price wage spiral. We're seeing a price wage slinky. They're both gradually coming down the stairs slowly. I think this is just going to continue all the way to 2%.